Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern, every Monday morning. Get you ready for the week, all the stocks to watch, economic news to highlight. Investors did get some surprisingly good news last week on inflation that signaled after one more rate hike this month, the Fed is probably done raising rates. That means even if the economy does weaken into the third and fourth quarter, the bull market should hold up as the Fed can eventually come to the rescue, lower rates, and support the economy and the stock market. Not all was good news though. The threat of litigation and cleanup for lead cables has tanked telecom stocks like AT&T and Verizon, with AT&T nearing a 20-year low. It's going to get worse before it gets better, but will it affect the dividend? I want to cover that in today's main topic. Stick around after that. We'll do our Monday market update with all the stocks to watch and economic news to follow this week. First though, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, click on the link I'll leave in the description below. All you out there in the Bowtie Nation know I love investing in these big trends, the disruptive forces that are changing our world. And these are the stocks that are going to do it. So click through that link in the description below, get your report, it's totally free, has those 5 stocks and my price targets on each. I want to get back to our main topic though, because over 2 decades of investing and more than 10 years as an analyst, I've seen these major lawsuits hit whole industries and just cause major stockholder pain for years after that. From the $206 billion settlement against tobacco companies in 1998 to the $54 billion opioid settlement just recently that bankrupted multiple drug makers over the last few years. So red flags started going up when I started reading about this issue with lead cables, something that could be just as big and cause telecom companies like AT&T and Verizon tens of billions of dollars. Both stocks are down more than 5% in the last month alone as this issue heats up. AT&T is down more than 21% this year as business struggles anyway. We could see another big drop if a multi-state suit is brought by states' attorneys generals, and I think that's almost a given at this point. It will mean an immediate drop in the shares and could overhang on these companies for years to come as well as threaten those dividends. So I want to explain what's going on with these lead cables, the telecom companies, what their reaction is so far, and how it could impact stock returns. For decades, phone companies used lead to wrap around their cables to cut electromagnetic noise in their phone lines and then to keep the water out. By 1940, the majority of phone cables were lead covered, and by 1956, the Bell system was using 100 million pounds of lead every year. When Ma Bell was forced to break up in the early 80s, all these telecom companies like AT&T, like Verizon, inherited that infrastructure, including all those lead cables. We've known for nearly 100 years that lead poses health risks. Warnings were going up as early as 1925 that the U.S. started restricting lead in paint and gasoline by the 70s. Telecom companies stopped using their lead sheathing in cables in the 80s, but the risk remains from all those cables still around. Recently now, a Wall Street Journal report has found more than 2,000 lead-covered cables underwater, buried, still hanging on phone poles, and that's likely just the tip of the iceberg. The journal found that of 200 environmental samples they took around those cable sites, 130 of those, about 80%, showed elevated levels of lead. And that is a huge health risk, not only to the telecom workers, but the Americans living in communities around those cables. Results here of a 1977 study of female solderers working with lead show incidences and health risks here. Here we see the CDC recommendation of no more than 3.5 micrograms per deciliter. We see risks in kidney functioning and fetal growth can occur as low as 5 micrograms. By 20 micrograms, you see decreased fertility, and from 20 to 40 micrograms here, anemia, bowel changes, even psychiatric problems. And that is where 93% of these solderers came in. And here, 5% of the group showed even higher, above 40 micrograms, with symptoms ranging from birth lung disease, thyroid issues, and decreased mental functioning. Even as recently as 2022, a study of 20 Verizon workers found 60% with some measurable levels of lead in their shin bones, and almost half with levels of 10 micrograms or higher per gram of bone. And the telecom carriers have known about this all along. A telecom industry presentation in 2010 led by a senior manager at AT&T highlighted the risks and warned that some older metro areas may have as much as over 50% lead cable. So this is all coming to a head and is going to be a huge issue for the telecom carriers. That presentation is likely going to be used in court to show that the industry has known about this for a long time and it's done little to mitigate the issue. AT&T did agree to settle a case in Lake Tahoe to clean up 95,000 pounds of lead cable in 2021 at an estimated cost of $1.5 million, but the cleanup has been repeatedly delayed. If the issue becomes a nationwide issue, which I think it will, an eventual settlement could easily reach into the tens of billions of dollars, with some early estimates as high as $50 billion to clean up all this lead. And with those stock prices already down so much, I think some of this is factored into the price, but the big issue is is it going to affect the dividends and the cash flow over the next few years? Now, we can look into the cash flow statement for each of these to help us compare the two stocks against each other, plus see any cash flow problems that might result as of this. We do see here in the Verizon cash flow statement, we do see that the company paid out $10.8 billion in dividends last year, but was not able to repurchase any shares. We'll see that in the AT&T statement. It also had to issue $4.2 billion, $4.3 billion in net debt. So it's issued more debt recently in the last few years than it's paid off. That could become a problem if that debt starts to accumulate and increase those debt problems for the company. And we can scroll down here and see that free cash flow was still a solid $10.4 billion, even after paying capital investment. So capital expenditures to keep the company rolling, capital investment of $23 billion. But debt is piling up here. For that, we go here to the balance sheet and we look under the liabilities and we see the total long-term debt and capital leases, $162.2 billion. That compares to just $92 billion in equity. So the company has a very high debt to equity ratio that we'll talk about later. For its part, AT&T did pay $9.8 billion in dividends last year, and it was able to repurchase $862 million in stock. So you can see here for the last few years, AT&T has had a stock repurchase program that in the worst case scenario, they could cut that, pull back that stock repurchase plan and save some cash for any kind of litigation. It also paid off $38 billion in debt. You can see this in the net issuance payment of debt. So a negative number here means it paid off more debt than it issued. And you can see out of the 4 years here, it has been paying down debt. Only 1 year it had to accumulate debt. It had to borrow more than it was able to pay off. Scrolling down here, we do see that free cash flow was $12.4 billion after spending $20 billion in capital investment. So the way they get this free cash flow number, they take the operating cash flow, which here it was $32 billion for the last 12 months. They minus out this capital expenditures, not all investing cash flow, but the capital expenditures, that was about $20 billion. So it comes to about $12.4 billion in free cash flow. Now, the debt here for AT&T is also fairly high, but not quite as bad. They owe $147 billion in debt. That's against about $106 billion in stockholders' equity. If we go here to the historical data tab and dividends only, we can see the dividend history for each of the stock. Verizon does have a stronger dividend history, increasing its payment for over 18 consecutive years. So very strong dividend payer here, now yielding 7.5% dividend. You can see those cash flow problems growing though, because the dividend growth has slowed to just 1.6% increase a year over the last 5 years. Now, for its part, AT&T was forced to cut its dividend last year when it spun off Warner Media, but still pays an attractive 7.3% yield. So just on the financials here, AT&T looks to be in a much better financial position going into these possible lawsuits. It only pays 44% of its earnings out to cover the dividend. That's the payout ratio on the stock. So the dividend amount per year divided by the earnings per share, that's 44% of those earnings to cover the dividend. Verizon's paying out 52% payout ratio. So right now, just to cover its dividend, Verizon has to take more than half of its earnings just to cover that dividend. AT&T is also going to be able to conserve cash by cutting that share repurchase program, almost $1 billion a year. It's buying back its own stock. Verizon is not able to do that right now. It also could slow down its debt repayment, which it's paying off debt faster than it's issuing debt, faster than it's borrowing money. Verizon, again, having to borrow more money than it pays back, won't be able to have that to conserve cash. AT&T also starts with a better debt position overall. Okay, we saw those debt numbers, the long-term debt divided by the stockholders' equity. That's your debt to equity ratio. At AT&T, that is just 1.38 times. For Verizon, 1.75 times. So much higher debt to equity ratio. That debt is accumulating. The interest expense on that debt could soon become a problem for the company and its cash flow, and it could all come to a head. That said, both companies do have the cash to support their dividends, though dividend growth is definitely going to take a hit. The overall outlook for each of them is not good as this lead cable issue heats up. I would avoid both of them until a big states attorneys general litigation is announced that could drop the shares possibly, and maybe even for a while afterwards. Eventually, that could be a buying opportunity, but could overhang these stocks for years to come. Well, look at a few of the stocks I'm watching this week. First off, Goldman Sachs, ticker GS, is likely to report an upside surprise Wednesday with the shares down 6% so far this year and really underperforming a lot of its peers like like JP Morgan. We can go here to the analysis tab and see how expectations for this quarter's earnings for Goldman Sachs have changed. We can scroll down here, and if you look in the EPS trend, management has gone out of its way to warn investors of a weak quarter and has really driven these expectations from earnings expectations of $7.59 a share down to just $3.18 a share just in the last month. Now, given fairly good earnings reports from the other major banks last Friday, Goldman likely went too far to warn investors and could easily beat expectations. Shares pay a 3.1% dividend here and could see a healthy bounce leading up to and into that reaction on earnings. I'm also watching Crown Castle, ticker CCI. We're going to be reporting its earnings on Wednesday with the stock nearing a 5-year low as those higher interest rates really bite into all real estate stocks. The owner of cell tower sites here is still seeing strong demand, though, and pays a 5.4% dividend while investors wait for that rate story to improve. This is a slow growth industry, though, with low single-digit sales growth expected and funds from operations, so that critical FFO measure are expected lower from $7.63 a share this year to just $7.54 a share next year. Now, that does make it cheaper, though, at 15 times FFO. So price to FFO 15 times here for CCI versus American Tower, the larger cell tower operator, ticker AMT. That's at a price of 20 times FFO. Though some of that premium is given on AMT's expected 8% increase in FFO next year. So whereas funds from operations are expected lower for Crown Castle over the next year, they're expected higher for AMT, a little bit better operating performance there by the larger cell tower company, but a much more expensive stock. So I still think CCI here a better on that valuation and a higher dividend yield versus just 3.2% for AMT. Taiwan Semiconductor Manufacturing, ticker TSM, could be the major surprise of the week when it reports its earnings on Thursday. This is the world's go-to chip maker. It's up 42% this year along with those other semiconductor and tech stocks, but it's also facing a weakening market for semiconductors. Taiwan just reported last week that its chip exports fell 21% from last June. That would be the 6th consecutive month of declines on slowing global demand for chips that go into everything from smartphones to laptops, everything out there. TSMC is expected to post a 22% drop in its earnings this year to just $5.13 a share on a 7.6% drop in sales, though both are expected higher next year. Now, I got to tell you, anything but a surprisingly strong beat on earnings or a very positive outlook by management could threaten the run that we've seen in these semiconductor stocks like Nvidia, like consumer tech stocks like Apple, because Taiwan Semiconductor is where it starts with the manufacture of those chips that are going to go into those products. Getting that big picture outlook here on the sectorspiders.com, the sector tracker over the last 5 days, we do see that all 11 sectors closed higher last week with really notable strength across the market. Every single sector was in the green here. Similar gains in tech, utilities, real estate, materials, industrials, sectors that are usually very lowly correlated here show that it was positive investor sentiment for the market as a whole rather than upside in any particular group for stocks. Okay, so very broad-based buying across stocks. A weakness in energy stocks, though, was also notable lately, with the price of oil reaching as high as $77 a barrel just last week from $67 a barrel in the weeks prior, but without that comparable jump in stocks in the sector. So I think if oil can maintain its price above $70 a barrel, investors are likely going to become more positive on oil stocks, and the returns in those stocks are going to catch up. Expanding out to the year to date, with inflation coming down, we could be moving into the early stage of the next economic cycle by the end of this year or early next. The economy is clearly weakening still into the third quarter, but that could change by the end of the year, early next year. If that is the case, investors may want to overweight stocks and sectors that tend to outperform during that phase, during the early innings of an economic rebound. Okay, stocks in real estate sector could do well as those interest rates start to come down next year. Financials should provide strong returns as that yield curve steepens. Even consumer discretionary stocks, which have done very well this year, they may still see some pain as consumer spending weakens into the fall, but should rebound quickly into next year. Get your free report, the 5 stocks I'm buying for the next 30 years, my forever stocks, or click on the video to the right for why Vanguard is forecasting just 6% stock market returns for the next 10 years and why I think they're wrong. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.